For nearly 100 years, the United States dollar has held a position that no other currency in the world has matched. It is the world's reserve currency. That means it is the most trusted and most widely used currency on the planet. But right now, something is changing. People around the world are starting to question whether the dollar can hold on to that power. There are three main reasons behind this growing concern, and analysts on Currency Matrix break each one down clearly. The first reason involves major countries like China. Over the past several years, China has been steadily selling off its United States dollars. Reports show that China now holds the lowest amount of dollars it has held since 2008. This matters because when a major economic power like China pulls back from the dollar, it sends a signal to the rest of the world that trust in the currency may be weakening. The second reason is inflation. Inflation means that money loses buying power over time. Right now, inflation sits at around 3.5%, which is higher than what the Federal Reserve and the US government would prefer. When inflation runs hot, the value of the dollar drops. People in countries holding large amounts of dollars start to worry that their money is quietly becoming worth less. The third reason is high oil prices. When oil prices rise, it creates uncertainty about the broader economy. And when there is uncertainty about the US economy, that uncertainty spreads directly to the US dollar itself. Investors begin asking hard questions about how strong the economy really is. Normally, when people become nervous about the dollar, they turn to what is known as the debasement trade. This includes gold, silver, and Bitcoin. These three assets are known for rising in value when the dollar weakens. Investors buy them as protection, almost like insurance against a falling currency. But here is where the story becomes surprising. Despite all these warning signs about the dollar, gold, silver, and Bitcoin have not gone up. They have crashed. Gold prices have dropped nearly 28%. Silver prices have been cut in half. Bitcoin has fallen almost 50%. All three dropped at the same time, which caught many investors off guard. This creates a confusing puzzle. If people are worried about the dollar and gold, silver, and Bitcoin are supposed to rise during dollar weakness, why are they falling instead? Is something wrong with these assets? Or is there something happening with the dollar that most people are not seeing clearly? To understand this puzzle, it helps to look at what the dollar actually represents. As the world's reserve currency, the dollar is used for global trade. If someone anywhere in the world wants to buy oil, they typically need US dollars to do it. This constant global demand gives the dollar enormous trust and power. That trust matters more than people realize, because the dollar itself is just paper. It is not backed by gold or any physical asset. It is backed by belief. In fact, it costs only about 12 cents to print a $100 bill. The reason that bill can buy $100 worth of goods is because people around the world believe it holds that value. And people believe it holds value because so many others use it to buy oil, goods, and services every single day. So when countries begin stepping back from using the dollar even slightly, it chips away at that foundation of trust. This is not a new trend. It has been building for decades. 25 years ago, the US dollar made up about 72% of the world's currency reserves. Countries stored most of their national wealth in dollars. Today, that number has dropped to about 57%. This steady decline shows that countries are saving less of their wealth in dollars than they used to. And when the world moves away from the dollar, it naturally moves towards something else, most notably gold. If less trust in the dollar usually pushes people toward gold, silver, and Bitcoin, then why did all three collapse at the same time? To understand this, viewers of Currency Matrix need to look closely at what has been happening behind the scenes with central banks around the world, and one major decision made in 2026 that changed the entire picture. For years now, central banks in several countries have been buying record amounts of gold. China has increased its gold reserves. So has India. Turkey has ramped up its purchases. Poland has done the same. On the surface, this looks like exactly what should happen when confidence in the dollar weakens. Nations protect themselves by holding a physical asset instead of paper currency. At the same time, more everyday investors began talking about Bitcoin as a modern alternative to gold, and silver, often seen as gold's more affordable cousin, was expected to rise alongside it. So the setup seemed clear. Central banks buying gold, retail investors buying Bitcoin, concerns rising about the dollar. Everything pointed toward higher prices for all three. Yet in 2026, the opposite happened. Gold, silver, and Bitcoin all dropped sharply and almost simultaneously. To understand why, it helps to look at one specific event tied to America's central bank, the Federal Reserve. Earlier in 2026, a new chairman took over leadership at the Federal Reserve. The previous chairman's term had ended and a new leader was appointed. Many investors assumed the new chairman would continue a familiar pattern, cutting interest rates and allowing more money to enter the economy. Lower interest rates usually mean more borrowing, more spending, and more money printing. And more money printing typically leads to higher inflation, which weakens the dollar and lifts gold, silver, and Bitcoin. This had been the general expectation since the start of the previous year. Many believed leadership would continue pushing for lower rates to support the stock market and the broader economy. That would have meant more inflation, and more inflation would have meant continued strength for the debasement trade. But the new chairman took a different approach. He made it clear that interest rates might not be cut, and in fact could be raised if needed to protect the strength of the dollar. He also stated that the Federal Reserve would stop giving hints about future decisions, creating more uncertainty rather than the reassurance many investors had hoped for. This announcement caught the market off guard. Investors who had spent the last 2 years buying gold, silver, and Bitcoin, expecting continued money printing and a weaker dollar, suddenly had to rethink their strategy. If interest rates rise instead of fall, the dollar becomes stronger, not weaker. And a stronger dollar is generally bad news for gold, silver, and Bitcoin. There's another important detail here that many new investors overlook. Gold, silver, and Bitcoin do not pay any form of regular income. Someone holding physical gold or silver simply owns an asset that sits in storage. It does not generate interest or dividends. The same applies to Bitcoin. Its value only increases if someone else is willing to pay more for it later. This becomes a problem when interest rates rise. If a savings account or government bond suddenly offers a strong, guaranteed return, investors begin comparing that safe, interest-earning option to gold, silver, or Bitcoin, which offer no guaranteed return at all. And when rates go up, holding non-interest-bearing assets becomes less appealing because money sitting in gold or Bitcoin is missing out on the interest it could be earning elsewhere. This is the core reason behind the current sell-off. It is not that people suddenly stopped worrying about the dollar. It is that a shift in Federal Reserve policy changed the entire calculation for investors weighing their options. As long as there is a chance interest rates could rise to protect the dollar, gold, silver, and Bitcoin face pressure, even while larger concerns about the dollar's long-term status remain very real. The sudden drop in gold, silver, and Bitcoin prices has left many investors asking a difficult question. Should they be worried, or is this simply a normal part of how markets move? To answer that, it helps to look at the wider consequences of this shift and how different people are being affected in different ways. For everyday investors who bought gold, silver, or Bitcoin near their recent highs, the emotional impact has been significant. Many were drawn in during 2025 when prices kept climbing, and these assets became one of the most talked about investments online. Watching gold fall nearly 28%, silver drop by half, and Bitcoin lose almost 50% of its value can feel alarming, especially for those who entered the market late, hoping to catch continued gains. This is where a key lesson becomes important. Prices for gold, silver, and Bitcoin do not move in a straight line. History shows this clearly. Back in 2008, when the financial crisis hit and the Federal Reserve began printing large amounts of money, gold prices soared. That rally continued until around 2012. But once fears about the economy faded, gold prices fell, and they stayed lower for nearly 8 years, all the way until 2020. Then, when the pandemic struck and interest rates were cut to nearly zero, concerns about the dollar returned and gold prices climbed once again. This pattern shows that these assets rise and fall based on how people feel about the strength of the dollar and the broader economy, not in a constant upward direction. Understanding this history helps explain why the current drop, while sharp, is not entirely unprecedented. Beyond individual investors, there are broader economic implications as well. If the Federal Reserve does raise interest rates to protect the dollar, it could have a ripple effect across many parts of the economy. Higher interest rates generally mean borrowing becomes more expensive. This affects everything from mortgages to business loans to credit card rates. At the same time, higher rates mean savings accounts and government bonds start paying more, giving cautious investors a safer, more predictable place to put their money instead of gold, silver, or Bitcoin. This creates a kind of tug of war in the economy. On one side, a stronger dollar policy could help control inflation and give people more confidence in traditional savings. On the other side, industries and investors who had grown used to cheap borrowing and rising asset prices may face new challenges adjusting to this shift. There are also global implications worth considering. Central banks in countries like China, India, Turkey, and Poland have spent years increasing their gold reserves as part of a long-term strategy to reduce dependence on the US dollar. A short-term price drop does not necessarily change that long-term strategy. Many of these countries are not buying gold to make a quick profit. They are buying it as a form of financial protection that plays out over decades, not months. This is an important distinction that often gets lost during periods of market panic. Short-term investors react to daily price swings. Long-term investors and central banks react to decades-long shifts in trust and economic power. This is why it is possible for gold prices to fall sharply in the short term, while central banks continue buying gold steadily in the background. For everyday people watching their investments drop, it can be helpful to ask a simple question. Is the goal to trade these assets for quick profit, or to hold them as long-term protection against economic uncertainty? Someone trading for short-term gains may feel real pain during a period like this, but someone holding gold or Bitcoin as a long-term store of value may view this differently. understanding that markets move in cycles and that short-term drops do not necessarily erase the reasons these assets were purchased in the first place. So where does this leave investors watching gold, silver, and Bitcoin right now? The truth is, nobody can predict with certainty what the Federal Reserve will decide next, or how quickly the situation will change. But there are a few important things worth thinking about. The first question worth asking is simple. Why did someone choose to invest in gold, silver, or Bitcoin in the first place? Was it to make a quick profit over the next few months? Or was it to protect long-term wealth against the possibility of a weaker dollar over the next 10, 20, or 30 years? The answer to that question often determines how someone should feel about the current price drop. Those trying to time the market, buying and selling based on short-term price swings, are essentially acting as traders. This approach carries real risk, especially when markets are unpredictable and reacting to new policy decisions from the Federal Reserve. Nobody can say for certain what will happen over the next 6 or 12 months. On the other hand, those who view gold, silver, or Bitcoin as long-term protection against inflation and currency uncertainty may see this differently. Short-term price drops do not necessarily change the long-term reasons these assets were purchased. History has shown that gold, in particular, moves in long cycles, sometimes rising for years, then staying flat or falling for years, before rising again when concerns about the dollar return. It is also worth remembering that these assets behave differently from one another. Gold has historically been viewed as a form of protection, almost like financial insurance during uncertain times. Silver often follows gold's movements, but tends to be more volatile. Bitcoin is different still. It carries characteristics of both a speculative technology investment and a modern alternative to gold, which is part of why its price swings can be even sharper than the other two. Looking ahead, several factors are worth watching closely. The direction the Federal Reserve takes on interest rates will likely play a major role in what happens next. If rates rise to protect the dollar, gold, silver, and Bitcoin may continue facing pressure. If concerns about inflation, oil prices, or global conflict resurface, these assets could regain their appeal as protective investments once again. Global central bank behavior is another factor to watch. If countries like China, India, Turkey, and Poland continue increasing their gold reserves despite falling prices, it may signal that their long-term concerns about the dollar have not gone away, even if short-term prices are down. For everyday viewers trying to make sense of all this, the most important takeaway may be this: understanding the difference between reacting emotionally to a price drop and making a thoughtful, long-term decision based on personal financial goals. Markets will always have periods of fear and uncertainty. Learning to recognize those moments, rather than panicking through them, is often what separates informed investors from everyone else. As this story continues to develop, viewers are encouraged to stay informed rather than relying on rumors or speculation. Following credible financial reporting, understanding historical patterns, and thinking critically about personal financial goals will always be more valuable than chasing short-term headlines. Every investment carries risk, and no outcome is ever guaranteed. It's always worth doing personal research before making financial decisions, and never relying solely on any single source of information, including this one. If this video helped explain what's really happening with the dollar, gold, silver, and Bitcoin, the best way to support this channel is simple. Share it with someone who might be asking the same questions. That's how Currency Matrix continues bringing clear, fact-based financial breakdowns to more people who need them. Thank you for watching, and stay tuned for the next update as this story continues to unfold.